know that historically, market crashes have created more millionaires than any other financial event? But only for those who know how to act quickly and decisively. Imagine being the person who makes smart moves when others panic, the one who sees opportunity where others see chaos. Market downturns may seem scary, but for savvy investors, they're a goldmine. The question is, will you be ready before the next downturn hits? Let's dive in and make sure you are. The clock is ticking. Experts are warning that a major market crash could be just around the corner. But here's the thing: with the right moves, this isn't a reason to panic. It's an opportunity. In this video, I'll show you how I'm taking a small amount of cash and turning it into a fortune before the market takes a nosedive. We'll cover everything you need to know, from understanding market cycles to practical investment strategies that anyone can follow, no matter your level of experience. By the end of this video, you'll have a solid action plan, the confidence to take control of your financial future. Ready? Let's get started. The biggest reason people miss out on building wealth isn't that they're lazy or lack ambition, it's fear. Fear of market crashes. Fear of losing what little they already have. And frankly, a lot of people just don't know where to start. That's understandable. Investing can seem complicated and risky, especially when headlines are screaming about impending crashes and recessions. But here's the thing: those same crashes are where fortunes are made if you know how to play it smart. Let's take the 2008 financial crisis as an example. Many people lost everything, but others saw an opportunity and made life-changing gains. They bought when prices were low, and when the market recovered, they reaped the rewards. This potential still exists today. Another remarkable example is the dot-com bubble burst in the early 2000s. While tech stocks took a massive hit, investors who held onto companies like Amazon, which had solid long-term prospects, eventually saw exponential gains as the market recovered and technology continued to revolutionize industries. During the COVID-19 pandemic market dip, savvy investors identified opportunities in sectors like e-commerce, video conferencing, and digital payment systems. Companies such as Zoom and Shopify skyrocketed in value once people adapted to new remote lifestyles. So, what stops people? The number one issue is fear. Fear makes people hesitate when they should be acting. Another major barrier is a lack of knowledge. Schools don't teach us about investing, and online resources often make it sound overly complicated or risky. Here's the truth: you don't need to be a financial expert to build wealth. You just need a game plan and the courage to take the first step. And that's what I'm here to help you with. The biggest reason people miss out on building wealth isn't that they're lazy or lack ambition, it's fear. Fear of market crashes. Fear of losing what little they already have. And frankly, a lot of people just don't know where to start. That's understandable. Investing can seem complicated and risky, especially when headlines are screaming about impending crashes and recessions. But here's the thing: those same crashes are where fortunes are made if you know how to play it smart. Let's take the 2008 financial crisis as an example. Many people lost everything, but others saw an opportunity and made life-changing gains. They bought when prices were low, and when the market recovered, they reaped the rewards. This potential still exists today. So, what stops people? The number one issue is fear. Fear makes people hesitate when they should be acting. Another major barrier is a lack of knowledge. Schools don't teach us about investing, and online resources often make it sound overly complicated or risky. Here's the truth: you don't need to be a financial expert to build wealth. You just need a game plan and the courage to take the first step. And that's what I'm here to help you with. So how do you navigate this and come out on top? Let's break it down step by step. First, diversification. This simply means not putting all your eggs in one basket. Spread your investments across different sectors so your entire portfolio isn't hit if one area tanks. Right now, sectors to watch include technology, renewable energy, and healthcare. These industries are poised for growth despite economic uncertainty. Next, let's talk about dollar cost averaging. This strategy involves consistently investing a fixed amount of money at regular intervals, regardless of market conditions. By doing this, you purchase more shares when prices are low and fewer shares when prices are high, which helps smooth out market volatility and reduces the emotional temptation to time the market. Let's break it down with a practical example. Suppose you decide to invest $500 per month in a stock or index fund. One month, the stock price might be $50, allowing you to buy 10 shares. The next month, the price drops to $25, enabling you to purchase 20 shares. By continuing this approach over time, you accumulate more shares at a lower average cost, even if the market experiences ups and downs. Compared to lump sum investing, where you invest all your money at once, dollar cost averaging offers the advantage of reducing the risk of buying at a market peak. However, it's not without its drawbacks. If the market consistently rises over time, as it historically tends to do, lump sum investing could yield higher returns because your money is invested sooner and has more time to grow. Another scenario worth considering is using dollar cost averaging during periods of economic uncertainty or when you're hesitant about market conditions. This strategy can help build confidence by taking smaller, less intimidating steps toward full investment. Ultimately, dollar cost averaging works best for investors looking to adopt a disciplined, long-term approach rather than seeking instant profits. It's a simple yet powerful method to gradually build wealth and maintain a steady hand regardless of market turbulence. This is when you consistently invest small amounts over time, regardless of market conditions. By doing this, you smooth out the ups and downs of the market. When prices are high, you buy fewer shares. When prices are low, you buy more. Over time, this approach helps reduce the impact of market volatility. Now, let me share a powerful story. John Paulson famously made billions by betting against the housing market during the 2008 crash. While everyone else was panicking, he saw an opportunity and acted. He didn't let fear dictate his decisions, he prepared and positioned himself to win. You might be thinking, that's great for a billionaire, but what about me? The truth is, you don't need millions to start investing. Even a small, consistent investment can grow significantly over time. Remember, every great investor started somewhere. Another strategy is understanding market cycles. The market goes through periods of expansion and contraction. Recognizing where we are in the cycle can help you make smarter decisions. Right now, we're seeing signs of potential contraction, but that doesn't mean you should sit on the sidelines. On the contrary, it's the perfect time to prepare and act. Finally, keep an eye on emerging market trends. Technologies like artificial intelligence, AI, clean energy, and biotech are expected to revolutionize industries in the coming years. For example, AI applications are not just transforming tech but are being integrated into healthcare diagnostics, financial modeling, and even creative industries. Clean energy is gaining massive momentum as the world pushes for sustainability, making companies involved in solar energy, electric vehicles, and battery technology poised for growth. Biotech, on the other hand, continues to innovate, especially with advancements in personalized medicine and gene editing. Additionally, consider the rapid development of virtual reality, VR, and augmented reality, AR, in sectors like entertainment, education, and retail. Blockchain technology and decentralized finance, DeFi, are also worth monitoring as they offer new solutions for financial systems and data management. These trends are not just fads, they are present paradigm shifts that will shape our economy in the coming decades. By staying informed and investing early in these sectors, you can position yourself ahead of the curve and potentially benefit from their exponential growth. Technologies like artificial intelligence, clean energy, and biotech are expected to revolutionize industries in the coming years. Staying informed and investing early in these sectors can position you ahead of the curve. Here's the game-changing insight. Timing the market perfectly isn't the goal, time in the market is what counts. The market will always have ups and downs, but history shows it trends upward over time. That's why starting now is critical. Consider this. If you had invested $10,000 in an index fund tracking the S&P 500 20 years ago, even with all the market fluctuations, your investment would have grown to over $60,000 today, averaging an annual return of around 8%. Visualizing this growth over time, a graph depicting the S&P 500's steady upward trajectory despite periodic downturns would clearly illustrate the power of long-term investing. This visual reminder reinforces the idea that staying the course through turbulent times often yields impressive gains. Even with all the crashes and corrections, your investment would be worth significantly more today. Waiting for the perfect time often means missing out altogether. And here's another tip: look for undervalued assets. These are stocks or investments that are priced lower than their intrinsic value. They're hidden gems waiting to be discovered. Tools like financial reports, earnings statements, and market analysis can help you identify these opportunities. Mindset is also critical. Successful investors don't panic when markets crash, they see it as a chance to buy low. It's about shifting from a fear-based mentality to a growth-oriented mindset. Remember, opportunity often hides in chaos. So, we've covered key strategies: diversification, dollar-cost averaging, recognizing market cycles, seeking out undervalued assets, and embracing the right mindset. Each of these elements plays a crucial role in positioning yourself for success. The bottom line is this: every market crash creates winners and losers. The difference? Preparation and action. By following these strategies and staying informed, you position yourself to thrive no matter what the market does. The future belongs to those who act today. So take that first step. Start small if you need to, but start now. Now it's your turn. What are your thoughts on investing before a crash? Have you had any experiences, good or bad, with market downturns? Drop a comment below and share your story. Let's learn from each other. And don't forget to check out my other video on advanced investment tactics for even more tips and strategies. If you found value in this video, give it a thumbs up and subscribe to the channel for more content like this. Together, we'll grow and succeed.